So I think ever since we got into this year, 2025, I think gold has been the best performing asset when you compare it to Bitcoin or to the stock market. And I think that's really the fear trade, right? It's the store of safety where we've seen this kind of weird dollar treasury movement away as a store of safety that's been historically kind of where money runs to, and it doesn't leave much else besides gold. And I think that's really been one of the driving forces with gold right now, is that we've seen again the safe havens be limited, gold to pull back here in the near term probably to about 3150, maybe even retest 3000. So just kind of interesting. And I want to be clear, and I always like to say this, is that I was a big gold bull over the last couple of years. I'm still mid to long term a big gold bull. It's just I'm also a trader. And so when I see a top, I'm going to use it to my advantage to either pare back my position or even short in the near term and then go long again for the next move up.
As of early 2025, gold has been the top performing asset compared to Bitcoin and stocks, driven by investor fear and a shift away from traditional safe havens like the dollar and treasuries. While the speaker remains bullish on gold in the mid to long term, they anticipate a short-term pullback to around $3,150 or even $3,000. As traders, they plan to take advantage of this dip by reducing or shorting their position before going long again on the next upward move. The speaker, Gareth Soloway, a prominent trader and analyst, discusses how Trump's aggressive trade policies and tariffs triggered foreign countries to retreat from U.S. treasuries, contributing to market volatility and rising yields. This pressured Trump to ease tariffs to stabilize markets, especially as the S&P dropped sharply. The conversation shifts to market trends, noting that while gold and gold miners, like GDX, look promising long-term, there may be near-term pullbacks worth buying. Similarly, rare earth and quantum computing stocks, which have been beaten down, might offer short-term opportunities. Regarding broader markets, particularly the NASDAQ 100, the speaker warns of resistance at current levels and predicts a potential 40% drop by year-end. Over the long term, he sees a possible lost decade like the post-dotcom era, where markets remain range-bound with no new all-time highs, though still offering strong trading opportunities. Let's explore the video in more detail. If you find this content helpful, give it a thumbs up and subscribe to stay updated with our latest videos.
I think what's going on here is we have Trump as the president now, and he's not afraid to ruffle feathers, and we've seen that, and I think everyone knows that. And so he's obviously initiated multiple trade wars, China, Europe, all of these other countries, where he's just said, hey, listen, we're going to levy X amount of tariffs on you unless we get exactly what we want. And there's a lot of countries out there where, in a weird way, it's kind of created a scenario where, hey, listen, we don't want to be buyers of treasuries. You know what? We're going to punish the U.S., if you will. We're going to steer away to other assets and buy those assets instead of helping keep the U.S. dollar and treasuries and the U.S. as strong as it has been historically. So I think there's a little bit of a fight back from a lot of these other nations that buy a lot of the U.S. debt. And that's why we saw when the stock market was collapsing, if we look at the chart here, usually when the stock market collapses, yields go down. And we saw yields going down here. And then once the stock market really collapsed because of the trade war, because of Liberation Day, all of a sudden yields surged to the upside. And I think that's one of the straws that broke the camel's back with Trump saying, okay, he's going to back off on Europe and some of these other countries and kind of bring it back down from 50, 60, 70% tariffs back to, let's say, just a minimum of 10%, because the bond market actually forced him to. Because again, these are the borrowing rates for the U.S., and we have to refinance $9 trillion in debt this year alone. And needless to say, higher rates don't help the economy. They basically stall the economy. Remember, the Fed raised rates to slow the economy down and bring inflation in versus lowering rates when we get into a recession to stimulate. And so this really put the president in a tough position where he had to say, hey, listen, maybe I need to back off a little bit because these other foreign entities may not be buying our debt like they once were. Short-term bearish, but long-term or mid-term bullish. We can see, look at this. This is the GDX. So this is the gold miners ETF. There's this trend zone right here that connects these highs. And we went right into it right here and pulled back. And we were extended short-term. This right here would be considered what we would call a bear flag. And so it's likely going to have a dip. And so for me, I'm going to start to look to accumulate if it gets down to about 46. maybe a little lower. I would probably start a position here at 46 and then add around 43 or 42 at this trend line. I still like it. Like, I think the miners are in now. We all know that the miners were forgotten for a long period of time. I mean, if you were a miner investor for years, you were like super disappointed while tech just rocked the house. I think that's shifting now. I think precious metals, rare earths, those are the things that will be key in the future. Because again, as we've talked about, sure, Doge is trying to cut spending, but in reality, these governments that want to hold on to power and to look good, they're going to probably have to go back to what has been stimulative in the past, which means fiat currencies getting printed, and essentially diluting the value of these fiat currencies. What will maintain the value is gold, silver, platinum, palladium, rare earths, stuff like that. We're even seeing REMX is a nice ETF that you can see here. This is the rare earth and strategic metals ETF. And it's actually, it's been beaten down. It's starting to show little signs of life. But, these are areas where I do think it's worth on pullbacks picking up some. Downtown, going back to the mega computer, the computing type side of things, quantum computing stocks, these have all been beaten down. You might be getting a little bull flag here for a pop to the upside. Again, I don't think it's going back to the highs anytime soon, but could this run back to $12 or $13, which nets 20 to 30%? I do think that's possible. And then other ones, you have Rigetti, RGTI, same kind of deal. Big bounce in the NASDAQ 100. We're kind of right up into this gap fill, which is going to be gap fills in technical analysis are generally resistance levels when you come from underneath. The market here closed this day. It opened the next day down here. That creates a gap. When it's filled, it's usually resistance. So this is kind of my first target where I'm starting to get nervous on the markets in terms of upside versus downside, favoring downside. In general, short term, I would say neutral to bearish. Midterm, I still think we're going a fair amount lower. So we're talking 1 to 6 months. We go down on the NASDAQ 40+%, I think, into year end at least. And then longer term, long term, if you're talking a couple years out, I think it's going to be a sludge. I wouldn't be surprised if we have what we call a lost decade, which is where the stock market doesn't make a new all-time high for as much as 10 years. Now, people look at me like I have 10 heads when I say that, but it's not super uncommon. Like if you go back on the NASDAQ to the .com era, when we put in that top in 2000, the year 2000, and I got to go to my weekly to go back, but that's what happened. The .com bubble, amount of the upside in this market with all the stimulus, with all the liquidity, with all the Fed intervention and everything like that. And we're kind of due for one of these periods where it's just, we get into this kind of choppy market, which can be great for swing traders and shorter term investors, but maybe isn't great for the long-term 401k investor.
Gareth presents a cautious yet opportunistic outlook on the markets, highlighting short-term volatility and potential declines across assets like gold and tech stocks, while maintaining a bullish stance over the longer term. Strategic pullbacks in key sectors such as precious metals, rare earths, and advanced computing may offer favorable entry points for savvy investors, even as broader markets face structural headwinds. What strategies can traders use to navigate a potential lost decade in the stock market? How might continued geopolitical tensions impact safe haven assets like gold and treasuries going forward? Share your thoughts in the comments below. We'd love to hear from you. If you found this helpful video, don't forget to give it a thumbs up and subscribe for more content.